July 31st, 2026, Camp David, a cabinet meeting. The kind of thing that generates about 90 seconds of B-roll and no headlines. Except a photographer catches something sitting on the table in front of Treasury Secretary Scott Bessent, a handwritten note that says, to do, buy Japanese yen, $5 to $10 billion. That's it. That's the whole photo. It is the first time in over a decade the United States has stepped into currency market to prop up another country's currency. So here's the question you must be asking. Why does the US Treasury care what the yen is worth? Japan is on the other side of the planet. Its currency problems are on paper Japan's problems. And the US just spent billions making sure it wasn't. So let's start with the number, because the number is what actually broke first. In July 2026, the yen hit its weakest point against the dollar in roughly 40 years. This is the first time in 40 years the yen was this cheap. This is an enormous decline. Japan had already been trying to stop the bleeding. Between April and May alone, Japan's Ministry of Finance spent close to $72 billion buying yen to defend it, one of the largest currency interventions on record. But the yen kept falling anyway. To understand why, you have to look at the interest rate gap. The Bank of Japan has been raising rates. They are now at 1%, the highest in 31 years. This sounds like Japan is trying to tighten its belt, but relative to global standards, it's really not. The US Federal Reserve rate is still miles above that. And when one country's interest rate is meaningfully higher than another's, money moves towards the higher rate. Every hike Japan makes closes the gap a little, but none of them have closed it enough to make significant change in bringing back billions of dollars back to Japan's economy. There is a second problem sitting underneath the first one, and it's not really about interest rates at all. It's about debt. Japan's government debt is more than double the size of its entire economy, the largest debt load of any major advanced economy on earth. And Prime Minister Sanae Takeshi has been pushing it in the opposite direction of what you would expect from a country trying to defend its currency. More spending, tax cuts, and relief for households dealing with the cost of living. It's good politics, but bad signal to currency markets, which read it as Japan isn't actually trying to tighten enough to fix this. So you get this strange picture, a central bank raising rates to defend its currency, and a government spending in a way that undermines the defense. The people buying and selling yen don't know which signal to believe, so it keeps sliding. On its face, this reads like a Japan story, a country with too much debt and a central bank playing catch-up, nothing to do with the United States. But here is where it stops being that simple. Before going any further, it's worth examining why a Japanese interest rate decision is treated like a global event instead of a local one. Because this isn't the first time a BOJ move has rattled markets outside Japan. It has happened before, recently and violently. Rewind to August 5, 2024. The Bank of Japan raised its policy rate by a small amount, from near zero to 0.25%. On its own, that's a minor technical adjustment. But for years, investors around the world had been running what's called a yen carry trade, a maneuver in the financial market where investors borrow yen at low interest rates and swap it into dollars to invest in higher yielding assets, especially US stocks and bonds. It works beautifully as long as the yen stays cheap and rates stay low. The BOJ's small hike, combined with a weaker than expected US job reports a few days later, broke that assumption. The yen started strengthening fast, which meant everyone who had borrowed in yen suddenly owed more to pay it back. They started unwinding the trade all at once, selling the assets they had bought to cover the loans. That selling pushed prices down, which triggered more margin calls, which triggered more selling, and that created a feedback loop. The result? The Japan stock market had its worst single day since the 1987 Black Monday crash, down over 12% in one session. It dragged US and European markets down with it. Roughly $790 billion in Japanese market value was gone in a day. That's the backdrop that makes 2026 so tense. The same trade has quietly been rebuilding since then. Investors going right back to borrow cheap yen to fund other bets, because the rate gap never really closed. That's the tightrope Japan is walking every time it moves. And it's the reason nobody in Washington wants Tokyo's currency crisis to spiral. A slow yen decline is a Japan problem. A sudden and disorderly one is everyone's problem. Back up and ask a different question. What's actually driving Japan's inflation in the first place? Japan imports almost all of its energy, and 2026 has been a bad year to be an energy importer. Because of the renewed conflict around Iran, oil prices shocks from that conflict have been feeding directly into Japanese inflation. Producer prices and energy cost rising is the kind of pressure that eventually shows up at the pump and on every receipt in the country. So the chain looks like this. A war in the Middle East pushes oil prices up, which pushes Japanese inflation up, which in turn forces the Bank of Japan to raise interest rates faster than it wants to for an economy that's already carrying more debt than it can comfortably service. and the currency cracks anyways, because markets don't think the hikes are catching up fast enough. And this part is not hypothetical or settled, it's moving right now. We have absolutely no idea what's happening between US and Iran. One day a deal is closed, an MOU is signed, and on another day, bombs are being dropped on ships. Which means the input that has been driving this entire currency crisis could ease or could fall apart before this video is even finished. This is one of those stories where the ground is still moving underneath it.
The inflation in Japan is driven by oil prices and the concern over fiscal policy. And that really translates into the rates differential between the US and Japan. That macro backdrop is not getting more favorable for the yen, it's actually going against the yen. So I think against this big backdrop from a macro perspective, the FX policy strategy maybe is more about slowing the pace of yen depreciation rather than really seeking to turn it around from a directional perspective.
But set that aside for a second, because the bigger picture is still unanswered. None of this explains why the United States opened its own checkbook to fix it. Here's the part that actually explains the Camp David notepad. Japan is in some country with currency problem. Japan is the largest foreign holder of US government debt, over $1.1 trillion in US treasuries. On top of that, close to $1.2 trillion in US stocks and another $300 billion in US corporate debt. Japan isn't a bystander in the American financial system, it's one of the load-bearing walls. Now connect that to the currency defense. If Japan keeps having to sell dollar assets to prop up the yen, the most obvious asset to sell is treasuries, the ones it holds over $1 trillion of. And if Japan starts dumping treasuries, that pushes treasury prices down and the yields up, which means higher US borrowing costs, which is already a live problem. 30-year US treasury yields just hit their highest level since 2007, before any of this yen drama even started. So picture the position Washington was actually in. Let Japan's currency keep sliding, and eventually Japan might be forced to sell the very bonds that are already under pressure at the exact moment the US can least afford it. But here is another detail that makes this whole story worth telling. It is the part that most news coverage skipped over. Look at how the US actually intervened. Normally, US would have to sell dollars to buy yen. It did not do that. It sold euros to buy yen, sidestepping a straightforward dollar sale. And alongside that, the US opened up something called the FEMA repo facility, which lets Japan borrow dollars against its treasury holdings instead of selling them outright. Think of it like some equivalent of pawning gold for some cash. The US is letting Japan use its own treasuries as a collateral to get more dollars. The US built Japan a way to defend its own currency without having to dump the bonds that would blow up the American bond market in the process. This wasn't really an intervention to prop up the yen. It was an intervention to keep Japan from having to sell US debt. That's the reveal the notepad was hiding the whole time. It reads like America flexing financial muscle to bail out an ally. It's actually closer to the opposite. The most powerful currency on earth had to step in because its own borrowing costs turned out to be hostage to a smaller country's stability. American financial dominance, when you actually look at the mechanics, is more leveraged than it looks from a distance. And there is one more layer of irony worth landing before you move on. This is a treasury that has at other points this year signaled it's fine with a weaker dollar for the sake of US's export competitiveness, and it just spent real political and financial capital defending the strength of somebody else's currency instead. The same administration, two different currencies, two opposite instincts. Because in this case, the thing actually at risk wasn't the dollar's value, it was the dollar's biggest customer. And you know what? This isn't the first time Washington has intervened directly in the yen's value. It's just doing the exact opposite of what it did last time. In 1985, the US, Japan, and 3 other major economies signed what's known as the Plaza Accord. Back then, the dollar was too strong, and it was hollowing out American manufacturing by making US exports too expensive. So the US deliberately engineered a weaker dollar, coordinating with Japan to push the yen up. And it worked, arguably too well. Japan's currency roughly doubled in value over the following years, which choked its export economy, and is widely credited as one of the ingredients in the asset bubble that eventually collapsed into Japan's lost decades. 40 years later, the US is back at the table with Japan over the exact same currency pair, except this time, it is defending the yen's strength instead of attacking it. It is worth pausing to translate this out of Wall Street language, because treasury yields and carry trades can make this sound like a story that only matters to hedge funds. It isn't. US treasury yields are the benchmark which dictates the rest of the American borrowing prices. When 30-year treasury yields climb to their highest level since 2007, that pressure shows up in your mortgage rates, in auto loan rates, in what it costs businesses to borrow to expand or hire, and it shows up in the federal budget directly. The US government has to refinance trillions of dollars in debt on a rolling basis, and every fraction of a percentage point added to their cost is real money, money that either gets borrowed further or squeezed from somewhere else. So if Japan's currency crisis has forced Tokyo into large-scale treasury yield selling, the realistic version of that story isn't an abstract market event. It would have pushed the yields up even further, that were already at multi-decade highs. It's not really about Japan at all. Once you follow the chain all the way to the end, it's about the interest rates on debt that funds the US government, and by extension, everything downstream of that. This isn't a story with a clean ending, and it shouldn't be scripted like one. The Bank of Japan is expected to raise rates again. Economists are split between October and December 2026, but political pressure from Takehashi's government is already cited as a reason it might get delayed again. The Iran variable is still live. A deal that would ease the energy prices would take real pressure off Japanese inflation, but as of this recording, nothing is settled, and the headlines are still moving by the day. And both Washington and Tokyo has said plainly that if yen keeps sliding, they won't hesitate to do this again. This wasn't a one-time fix, it's an ongoing position. So what's actually worth remembering isn't the yen's exchange rate on any given day. That number would be different by the time you watch this. It's the mechanism underneath it. A war half a world away and a domestic political fight in Tokyo over tax cuts don't just stay in Japan. The United States and Japan's economy are joined at the hip, and the fault lines that come out of Japan are not just Japan's problems.